Well, here we are, and welcome. Thanks for spending some of your Tuesday evening with us, enjoying the chat this evening. It's quite a lot easier not having a guest on to worry about too. I just immerse myself in the chat and let's put the pre-show on for a moment or two. Good to see so many on already, and there's a lot going on tonight, a lot we're going to talk about, and we're going to try a few experiments and things as well. So it's good to see so many on, and I'm sure we'll get a few more coming just a little later as well. Joe, the story is quite an interesting one with the RBA and what they did today, and what we're seeing in terms of our analysis and the modelling. We'll show some new models as well that we've built and a few other things as well, and obviously plenty of time for questions, and we might even look at a few postcodes, and Cookie Boy might be helping me out with that, so it should be a bit of fun. Plenty to immerse ourselves in tonight, I think. Right, well, I'll just let the seconds tick by for a moment or two longer, just to give people the chance to come in and make themselves comfortable. If you haven't liked the post yet, please do so. It's always really important to help get the message out there. So always appreciate your liking and subscribing if you've not subscribed either. So there we go. Let me just get rid of the pre-show. I'm going to run the intro and I'll be back in just a moment. Well, good evening and welcome to this live stream on the 1st of November 2022. Martin North from Digital Finance Analytics here. Great to have you along this evening. And plenty of stuff going on. No guest tonight, just me. But I think it will be hopefully quite an interesting show. I want to take you through some of my own analysis, but also look at some of the broader information, stuff from the RBA and CoreLogic's data as well, and some other information too. So as normally, let me just start by reminding you about the house rules. This isn't financial advice or legal advice, it's just a general conversation. If you need financial advice, go find a financial advisor. I am not he. Please do play nice in the chat room. We do moderate the chat, no racial slurs, etc. But I do encourage you to, engage in the chat, and there's always plenty of conversations going on. I don't necessarily follow them all, simply because there's too much else going on. This is as at the 1st of November 2022, if you're watching this in replay. Use that Walk the World if you want to get my attention, specifically if you want a postcode lookup or anything else. It's the only way I can be sure to see it. It goes into a special queue, and then I can use that queue to actually bring it into the screen. And also I've enabled Super Chat, which means that if you'd like to make a contribution to what we do here, you're very welcome to use Super Chat to do that, or indeed get your question to the top of the list. So there you go, that's the plan of campaign. Now, I want to start this evening with the word of the year. It's this. Permacrisis is the 2022 word of the year according to the Collins Dictionary, and it's defined as the word permacrisis. It's been appointed as Collins Dictionary word of the year to sum up the tumultuous period people have gone over the world, all over the world have gone through in recent times. Defined as an extended period of instability and security, and it's one of the several terms on the 2022 list. So there you go. Mark your diaries. You heard permacrisis. I think to my mind, it rather sums up rather well all of the stupidity that's going on at the moment. A lot of really, really stupid things. And, we have sort of crises falling into each other. So permacrisis is now a word. It's a thing. Now, what I'm going to do is going to go through a few slides now. So I'm not going to look at the chat while I'm doing that. So if you've got a specific question, hold off and let me come back to that a bit later. But we should just look at the RBA decision. Of course, it was 25 basis points, lifting the cash rate to 2.85%. They also increased the interest rate on exchange settlement balances. In other words, that's the money that they're now paying to all of the banks for money held at the exchange settlement accounts. Of course, a lot of the banks still have parked a lot of term funding facility money, which they got at 0.1%. And so by definition, they're getting 2.75 minus 0.1% on balances outstanding. So that's a pretty nice earner for the banks. I hope you feel good about the fact that you are essentially making a contribution through your tax payments to bolster the profits of the banks. So congratulations on that. I have to say, it's nuts. Interestingly, in the Eurozone, the ECB has started to use an alternative strategy to try and encourage banks to pay back those equivalent cheap loans that were made, but no sign of that from the RBA. So the RBA is just going to roll with it, and that means the banks will have some excess profits from the taxpayers and all those things. Great, isn't it? So anyway, the 2.85%, and they also said that they now expect inflation to peak at 8% next year. Now that's higher than what was said in the budget. It was 7.75%. And of course, they still are holding to their expectation to decline next year due to the ongoing resolution of supply-side problems, declines in some commodity prices and slow growth in demand. Now, anybody who's been watching this will notice that they keep talking about declines later. They just keep pushing the later out. Medium-term inflation remains well anchored, they say. I wonder about that. And the bank's central forecast is for CPI to be around 4.75% over 2023, so still well above the target. And here's important, a little above 3% over 2024. And they went on to say that the Australian economy is continuing to grow solidly. Central forecast for GDP revised down again, growth of around 3% this year and 1.5% 23 and 24. Then, of course, their normal comments about the labour market, very tight. Unemployment rate was 3.5%, lowest in 50 years. Vacancies and job ads are still at high levels. Central forecast for the unemployment rate is to be a little above 4%. So expect unemployment to rise. Wages growth, they say, continues to pick up, though it remains lower than in many other advanced economies. And they expect a further pickup. Now, it's just worth reflecting on that because, of course, the budget suggested there'll be no real wages growth until at least 2024. So whilst wages growth might be up a little bit, inflation's up a lot more, so we're still going backwards. So there's no real hope there, I think. And they're saying that price stability is important, prerequisite for strong economy. So their priority is to return to 2 to 3%. While keeping on an even keel, the path to achieving this is a narrow one, clouded in uncertainty. You could say that. And the outlook, of course, for the global economy is one of those average uncertainty, as is household spending. Consumer confidence is also falling, and house prices have been declining. We'll touch on it a bit later. And they expect further increase in rate. They expect further increases in rates over the period ahead. Size and timing will be TBA, but the board remains resolute in its determination to return to inflation to target. So in a way, not a lot's changed other than inflation is going to be high for longer, that they still think inflation will come back down. And it's an interesting observation, isn't it, that they still think effectively inflation is going to almost magically come back down. Now, of course, I think they're assuming the base effect will be what's going to do that, because the base effect means that when there were big run-ups last year, they will drop out over the next few months and come down. But of course, current inflation rates are still remaining very high, as we saw earlier with the data, 7.3%. And of course, non-discretionary inflation's above 8% at the moment. So that's really not too good. So 8% is the latest one. The question is, when will it get to 10%? That's going to be the interesting question. So I wasn't very impressed with that. I feel that the RBA should have done more than 25 basis points, but having set the precedent last month for 25 basis points, it didn't really surprise me that they did no more this time. And in fact, I've been on the media quite a lot today. I did a thing on ABC Illawarra this morning. You can actually see it on my YouTube channel. And I did something for the PM program on the ABC. I did something on TNT Radio, and a couple of journos also called me for the newspapers. So you'll see me being mentioned in various places over the next couple of days. Now, the other thing I did was I just set up a poll, and I want just to highlight that I wanted to get your views as to the question was, the RBA did 25 basis points today. Which is most true? Firstly, they lifted as expected, or they should have done more, or they should be cutting rates, or they are doing whatever it takes to save property. Be very interested in your perspective, and by the end I'll report back and see what the audience thinks about which of those four are most true. Now, you might think that two or three are true, but pick the one that's the most true. Quite interested to see how that poll pans out. Okay, now let's just go on then to the next part of the conversation, because one of the really interesting things is, how did the market react to the RBA? Well, here's one interesting observation. So this is the interbank cash rate, the implied yield curve, and you can see there that the April 24, this is now the extra month that's dropped in, is at 3.885 according to the markets, and March is still 3.9, so it's not really changed much before the cash rate announcement today. So in other words, the markets are still saying they think rates will be higher than what the RBA thinks. And as to what happened there, well, the ASX 200 had a bit of a spike up. Now that's partly to do with the US on Friday and Monday, but also I think to do with the fact that now they're thinking the RBA is closer to a pivot. Well, we shall see. What's also interesting is that the 2-year bond rate dropped, so it's now down to 3.183. You can see that it was quite recently above 3.6%, so that's quite interesting. And the Aussie dollar, well, it's around 64 to the US at the moment. That'll be one to watch, particularly after the Fed, because, of course, the Fed is likely to put rates up by 75 basis points. And that means that the exchange rate differential between our interest rates and the US ones will be significantly worse. I expect to see our Aussie dollar continuing to slide, and wouldn't be surprised if we get below 60 over the next little while. So all up, wasn't a particularly encouraging set of events today, but of course the markets celebrated the smaller rate rise because people thinking they're closer to the pivots, and of course they've redefined pivot now. Pivot means slowing rather than cutting rates. I think it's highly unlikely that we're going to see interest rates cut through next year, because the inflation will still be above their target. So it's likely to be 2024 before we see rates coming down. And that's worth thinking about in the context of property prices. Now, with regard to property prices, just worth highlighting this. This is from the CoreLogic, that over the month, nationally prices were down 1.2%, over the quarter 4%, and annually we're now down below where we were this time last year. Varies, of course, across the different locations. Brizzy over the last quarter was down 5.4%. That's consistent with Cookie's analysis that I've shared in some of the anti-spooks, that Brisbane's definitely on the dive, but Sydney's at 5.3. Canberra's down 4.3. And interestingly, 4.3, of course, is worse than Melbourne. Now, the reason I'm interested in Canberra is because I'm not sure that everyone's fully across what's going on in Canberra at the moment. There seems to be some funny things going on, so we might look at some of those a bit later on. And of course, the markets are somewhat up, so the annual change is varying. Obviously, Adelaide's still hung in strong. Brisbane is still a bit above where it was, but some of the others are now in reverse. And this is a really interesting observation from CoreLogic. Across the 310 SA3 sub-regions, excluding areas with low sales and low confidence scores, only 16 regions remained at cyclical highs at the end of October, with a skew towards the more affordable areas of Perth and Adelaide. And a mix of regional markets, home values have continued to fall at a faster rate than unit values across most regions, and that's consistent with what I have been seeing. And here's the rolling 3-month change. So you can see there that Sydney's down 5.3, Brisbane down 5.4, Melbourne's 3.1, Perth 0.7, Adelaide down 0.6 over the last 3 months. And in terms of the capitals versus the regions, pretty close. Combined regions down 4.1, capitals down 4. And here is a bit more of a summary. You can look at the various elements here to see where the movements are. Obviously, Brisbane is looking quite significant over the last quarter. But then if you look over the last 12 months, it's still holding its place. Regional South Australia is doing pretty well at the moment. That's probably the last bastion, to be honest. Adelaide's not doing too bad, but beginning to, perhaps come back now, but from a high base. So it's quite interesting just watching Adelaide being effectively the last area standing. Tasmania is continuing to slide now as well. They also made the point that the declines are getting quite significant now, and of course they've got the peak to trough measures, so this is from the COVID trough. That of course is artificially low because we had a significant slide before things moved up again. And the other interesting observation is new listings. So the new listings is going up and is tracking a little higher. I did a show with Edwin yesterday on that. But also the 28-day count combined capitals still somewhat lower than it has been. So there's some mixed news with regard to listings. And the monthly volumes of dwelling sales are sliding down, as you can see, compared with 21 and 22. 21 is there, 22 is there, and this is the previous 5-year average. So we're actually now looking at sales below the 5-year average. Finally, annual changes to rents. Still significant hotspots in Brisbane and Adelaide, Perth, Sydney. Darwin is at the bottom of the pack there. That's for houses. But units, a bit different. Melbourne units are certainly running hot, as are Sydney, with Brisbane and Adelaide following behind and Darwin the weakest. Some of that's to do with migration. Some of it's also to do with people moving because they're trying to find alternatives. Now, just to remind you also, confidence for consumer confidence fell. This is last week's data because Melbourne was on holiday today. So consumer confidence is right the way down the bottom of the range. And what I will go in a second on is to talk a little bit about my models and my analysis. But before I do that, I'm just going to have a quick look at the chat just to see what, if anything, we should be talking about. Let's have a look. Let's get rid of that. So we'll go there, shall we? So this was one from Momentum who asked about my thoughts on the RBA and interest rates, targeting exchange rate. How much can the RBA hold back on rate rises as the other dollar is falling to the US dollar? Well, I think that's the critical issue because as the exchange rate drops, of course, we import inflation. So, for example, petroleum products, we import those, in terms of US dollars. So if the exchange rate differential gets too big, then effectively that's going to put more inflationary pressure into the economy. Okay, it makes our exports cheaper, but that's not necessarily going to help. So that, to my mind, is one of the big questions which I'm not sure that I've got a strong read on yet, other than it looks to me as though the RBA is prepared to see a weaker Aussie dollar at the moment. But I don't think it can be too weak because it also puts significant pressure on bank funding, of course, if they're going to raise funds in the US. So it is quite significant. So that's one to watch. My own belief is the RBA is going to get left behind because we're going to see the Federal Reserve continuing to lift rates higher. We think the ECB will also lift rates. Of course, New Zealand's lifting rates as well. We are the one that's standing out, and even Canada lifted their rates by 50 rather than 75, so they sort of came back slightly, but they're talking about higher rates too. So to my mind, we are, I think, off key. The reason is, of course, that we've got such massive leverage into property, and the RBA, I think, is pretty scared now about what may be happening if, in fact, rates go much higher, because the typical mortgage holder is probably now paying around $1,000 more each month on an average mortgage. It depends obviously on the mortgage and location, but it's a big amount. And so for many people, it's going to be a real struggle, I think, to try and find a way through. So that's my thought on that particular question. I'm just going to quickly go back up, see whether there's anything else. Prospects for the ACT 3 to 4 bedroom houses. Yeah, we might look at that. I'll show you a couple of ACT data points a bit later, because there are some interesting issues. I was going to focus specifically on 2600 and a few around there, so we'll come back to that because it's very interesting. All right, so let's go back to the presentation, and let me just quickly remind you, so there will be some new people on. I model this on an ongoing basis. I survey households and look at the various elements, including from our surveys, and also pull information from other sources into our core market model. And that includes our rolling household phone surveys. So this is up-to-date data. We get it back each week. And I ran the models up till the end of the month. And we can slice and dice the data and also put some data into our various scenarios. We'll touch on the scenarios a bit later. And that allows us then to have a look down to the postcode level and think about things like mortgage stress, the trajectory, the buying and selling intentions, migration, economics, and put it through the core market model and then come up with an estimate of where things may be going. And this is down to a postcode level. Because one of the things I keep saying is you cannot look just at these aggregate levels. So the core logic indices is quite unhelpful. One, it's lagged by perhaps up to 70 days, and two, it's too generic. It doesn't really differentiate sufficiently in particular geographies and locations. So it's pretty important to get granular, and that's what I try to do in my modelling. And incidentally, just on passing, for those who are interested in perhaps a more detailed conversation about a particular area, I do that for my one-to-one service. It's a confidential conversation. We can give you data about a particular postcode. It's not financial advice, but I can look at the underlying trends and data. I can look at stress, home price, and some trending ahead based on the modelling. About an hour by Zoom or phone. And there's a charge involved simply because it's a lot of work to put it all together. And if you're interested in getting information about that, then you go to my blog. On the blog, there's a contact me form, and you can actually ask for more information. We're booking about 3 to 5 weeks ahead at the moment. And I will just make the point that I've got quite a few queries on my inbox. I'm a bit behind just because I've been so busy, but I will get to them. So even if you haven't heard back from me in a week or two, don't worry, I will get back to you in due course. All right, now let's talk about the mortgage stress and definition of stress. There are many different definitions, of course, but I use a cash flow measure, money in, money out. That's really important these days because it also means that I'm thinking about not only the mortgage, but the other costs. You know, we know the inflation rate's very high. We know the cost of vegetables and other non-discretionary issues are all there. So this is actually quite an important way of thinking about it. So cash flow terms, money in, money out. And if households have more outgoings, excluding one-off discretionary items, than income, then we define them as stressed. If they have a mortgage, then they're in mortgage stress. If they're renting, they're in rental stress. And investors with cash flow pressures are identified as stressed investors. And we can also aggregate the data to total financial stress, which is all types of stress from all categories of households. And we can calculate it as a percentage of households and the count in each postcode. I use the latter most of the time, but tonight I'm going to show you the percentages because a few people were asking last time about the percentage in postcodes, so I'll show some mapping later on that. Now let's look at mortgage stress as October 22, so this is the latest data. And the first thing to say is that rental stress is still at a massively high 61.44%. It came back very slightly compared with last month. That's partly because some people are moving to cheaper accommodation or moving back with parents, but also the fact that in some areas, some of the rental scenarios are a little bit different from where they were a couple of months ago, but it's still very high, 61% of households. Just wanted to share this little cameo. Luna's got up, walked around, and sat back now and again, and is now sitting side by side. Very interesting, because they often sit apart as if they've squabbled. Anyway, so back to mortgage stress. So we've looked at rental stress, and you can see it's pretty high. Mortgage stress is at 45.2. It's just back very, very slightly, very close to the last month. That's because some people are refinancing. And by refinancing, some people are able to get themselves back into slightly better situations, not least because when they refinance, a lot of people, about 2/3, pull equity out of the property too and pays down debt, which means it improves their cash flow in the short term, but only in the short term. It doesn't solve anything unless they change their behaviour. And then the third one is just on household debt. This is from the RBA data, and you'll notice it's going up again. So 187.5 is the ratio. Now that's a bit deceptive because that's all households, including those not borrowing and SMEs. So you need to multiply up about 3 times to get the true ratio. So it's about 187, let's say 200 times 3, so 600 times the ratio between the debt and income. In other words, people are 6 times, on average, 6 times income. That's pretty high. Now, here is the data for October, and as normal, I just displayed it by state. You can see here that overall mortgage stress is at 45.19%, rental stress is 61.44%, investor stress is at 21%, and financial stress is at 43%. Now, I've marked them here. If it's bluey, that means that it's an improvement on last month. If it's yellow, it's worse than last month. So you can see here that from mortgage stress, there was an improvement in New South Wales and the ACT. That's very much associated with people who've refinanced in the last couple of months. Whereas in the Northern Territories, Queensland, South Australia, Tasmania, Victoria, they're all gone up. WA's come down a bit, again because of refinancing, and the overall total is very similar to last month. In terms of rental stress went up in the ACT, and it went up in South Australia and Western Australia, and it came down slightly in New South Wales, NT, Queensland, Tasmania, but really isn't hugely different from last month. Investor stress was higher in ACT, New South Wales, Northern Territory, Queensland, South Australia. That's because of higher mortgage payments now on investment properties, and even if they've put the rent up, it's not necessarily enough to cover the costs. A little bit of an improvement in Tasmania, no change in Victoria and Western Australia, and so it was around 21%. And then financial stress, which is the aggregate measure, shows that it was down slightly in ACT and New South Wales, up in the Northern Territory and South Australia, down in Queensland, down in Tasmania, up in Victoria, up in Western Australia, and the overall total was pretty close. And you can see here the count. So 1.7 million households in mortgage stress, 1.9 million households in rental stress. And overall, of the 9.7 million households, financial stress is touching just over 4.2 million households, or 43% of households. So it's quite significant. Here's the segment data, and I won't go into this into a huge amount of detail, but just to highlight that mortgage stress is highest amongst young growing families, including a lot of first-time buyers, at 84%. It's also high on the urban fringe and in the battling urban groups at 73% and 67%. A little lower in some other dimensions. Rental stress, of course, is highest amongst the first-generation Australians, what I call the multicultural establishment, and also some older households who are long-term renters, as well as some wealthy seniors and young affluents and some young growing families, so it's quite widely spread. Investor stress, funnily enough, those with more investment properties like exclusive professionals and young affluents are where the most of the stress is, so property investors are struggling at the moment. A lot of returns are negative. And overall financial stress is highest amongst young growing families, of course. That includes first-time buyers, battling urban, so those on the fringe, and also young affluents. Those are the people who have higher incomes, perhaps younger, but also massive mortgages. And a lot of it's to do with the size of the mortgages they have. Now, let's just quickly run through mortgage stress. So what I've done is just given the top few, and I've sorted it by the number of households in a particular postcode. So the postcode with the highest number is in Liverpool, 2170, with more than 11,500. And then a WA postcode 6065, including Tapping, with 11,000. Then we go to areas around Toowoomba at 4350, more than 10,000. Then we go to Roxburgh Park and places like that in Victoria at 3064 with 9,900. Then another postcode at Hoppers Crossing, 3029 with 9,000. Now, this last two, and Narrow Warren, the next one, 3805, including Fountain Gate and Narrow Warren with 9,000. These are all high growth corridor areas. Same to be true there at Berwick and Harkaway as well, 3806. So you can see the tranche of Victorian high growth corridors with a lot of households. Then we go to Riverston, including places like Nelson and Vineyard, Berkshire Park. And then we go to Cranbourne in Victoria, another high growth corridor. Back to places like Camden, 2570 with 8,000. Pakenham in Victoria, another high growth corridor, 8,200. Ballarat, regional centre, with more than 8,000. And then down to Tasmania, in and around Launceston, with more than 7,000 there. So that's the top stressed postcodes for mortgage stress. If I then do the same for rental stress, Toowoomba's right at the top of the list, with more than 10,000 in rental stress. Then we go to Liverpool, and 2170 with 9,700 rental stressed postcode house codes in that postcode. Then we go to Southport, Labrador, on the Gold Coast, 9,300. Then we go to this one here at 3560, including Campbelltown and Lima and places like that. Then we go to Lethbridge Park and Bidwell. Then we go to Greystanes and Wentworthville and South Wentworthville and Westmead. Still with more than 8,500. Then Waterloo, Zetland, New South Wales. Then down to Cranbourne again, in Victoria with more than 8,000. Then we go to Ipswich and the areas around there with more than 8,000. Out to Parramatta and Harris Park with more than 7,700. Then up into the Central Coast around Gosford with more than 7,500. And up to the areas around Bundaberg with more than 7,300. If I then do the stressed investors, so these are the people with investment properties in these particular areas. So you can see that the investment properties in the centre of Melbourne are not doing well at all. They actually have some of the biggest counts. Then we go to Toongabbie, Crow's Nest, Surrey Hills and Darlinghurst in New South Wales, Newstead and Fortitude Valley in Queensland, Westmead in places like that in New South Wales. Then we go to Windaroo and Yatala. Then we go to Southport and Labrador again. Then Wyong in the Central Coast. Then close into the centre of Sydney, I guess a bit equivalent to Melbourne. And then St Kilda in Victoria, Highgate Hill in Queensland. And then we've got Lane Cove and places like that in New South Wales. And finally, financial stress overall is highest in Campbelltown, postcode 2560, followed by Toowoomba, 4350, 23,000, 22,000. Then Liverpool at 22,000. Then Cranbourne in Victoria, 18,000. Centre of Melbourne at 18,000. And then Mount Druitt, Bidwell, places like that, 2770 with 17,000. Hops Crossing with 17,000. Roxburgh Park, Craigieburn, 16,000. Ipswich, 15,000. Tapping, places like that, 14,900. Point Cook, Derrimut, 14,800. Southport, Labrador, up in Queensland, 14,300. Greystanes, Wentworthville, places like that, 14,100. And so it goes on. Tamworth is on the list at 14,000. Ballarat, another regional centre, at 13,000. And then we go back to Camden, Grasmere, and places like that at 13,000. So that gives you a bit of a flavour, as you can see how it all looks. So of course you can see here that the stress is spread quite broadly across different areas. A lot of newly developed postcodes, a lot of high growth corridors where a lot of people bought relatively recently, quite often at the top of the market. They've got big mortgages, they're highly leveraged. They're also in areas where the infrastructure is not great, so they're having to spend a lot more to get around, and of course the cost of fuel is quite high at the moment as well. And they've also got more limited infrastructure more generally out there as well. So, but I will highlight that other areas too, like Central Coast, for example, is also in some difficulty. So wherever you look, there are these pockets. Now, I think it's going to continue to deteriorate because rates are still going up. Of course, it takes 2 to 3 months for the interest rates, when they're actually announced, to flow through. And NAB announced, for example, today that they're going to start putting the rates up next week I think the 11th of November, so I'm sure everybody else will follow on with that. It means that people will still be seeing their mortgage repayments going up higher and higher each month for the next few months, whatever the Reserve Bank does. So there's a lot more pain baked in, unfortunately. And whichever way you look at it, it's not a very pretty picture. All right, let me just pause. I'm just going to have a look and see the latest with regards to the chat. Momentum's you're hot tonight, Momentum. Do you think the issue with the property market right now is due to the past government or current government? I feel the Morrison government wanted the property market to boom. This is a long-term structural issue, so this isn't just Morrison. This is really something that's happened over the last 20 to 30 years, because you can identify, firstly, deregulation of the financial system. So it used to be 30 years ago, 3 times income was what you could afford. So that sort of put a cap on what people could borrow and therefore where prices could go. Then they deregulated the financial system. They got a lot of non-banks coming in. They started securitizing. They started opening up the financial markets and got international players coming in as well. So that started then to put more momentum into lending. And the thing to understand is that the biggest lever in terms of property prices is availability of credit. If credit is easy, in other words, income multiples or interest rates, if those are easy, property prices boom. That's why through COVID, when they cut rates to 0.1% and threw a lot of stimulus in, people were able to borrow a lot more, and so prices went up. The reverse is now true. Property prices are falling because interest rates are rising and because your borrowing power is now, let's say, 30% on average down from where it was. So this relationship between credit availability is the fundamental thing. Now, then you ask the question, so why? Well, in the early 2000s, we had a miming boom that went off. The Reserve Bank then said, well, we need to find something else, and they basically put all of the eggs in the home basket, household basket. So that's really the next wave. They took rates down. They released the lending standards and continue to do, and even today, people are still getting 6 to 7 times average income in some areas, which is still way too high than it should be in my view. And of course, they took the buffers down. So originally, APRA had a headroom of about 7 or 8%. And then they said, well, no, we'll just do it at so many percent over the interest rate, 2.5% initially, and then put it to 3%. When rates came down, that meant people borrow significantly more. Now, of course, the reverse is true, which is why borrowing power is reduced and why I'm saying 30% down is typically what people are doing. And in fact, some people are now struggling because they had an offer from the bank on the old basis before interest rates started to move with a time limit on it. And then they go back to the bank and they ask now what they can borrow. And the bank says, well, you may have the same income and expenditure profiles, but because of high interest rates, we've got a high buffer, which means we can't now offer you the same amount. So that's another reason why prices will continue to fall. So this is a long-term structural issue. This is not a bubble as such. It's much more structurally significant than that. And that's why it's going to take a long, long, long time to be able to shake all of this out. All right. Now let me just then go on to the next bit of the conversation. What I wanted to do now was to show you some of the stress mapping, because I think the stress mapping is actually quite a powerful tool when it comes to looking at where the problem areas are. So I'm going to switch across to here. Now this is actually the stress map for Sydney. We can look at other areas as well. And I just want to explain, as I always do, that the lowest stress is the bluey ones, and the red and the orange ones are the higher. And you can see here on the key that you've got 7% and below, 7 to 19%, 19 to 31%, 31 to 43%, 43 to 57%, 57 to 72, 72 to 89, and 89 and above. So the more ready, the more the proportion of households are actually going to be in difficulty. And you can see here that you can immediately draw a bit of a line down Western Sydney from the Hills area down through Blackdown, down through Fairfield, down past Liverpool and into Campbelltown. That's where a lot of the hotspots are. And of course, it's quite similar to the counts. I've shown you the counts on other occasions, but this is actually just a slightly different way of showing the same information. Now, you've got to be careful, because if you have a very small household count, with a high level of stress, it will still show as red. But nevertheless, it does make quite an interesting point. And then if you drill into areas around the harbour, for example, let's just go and do that, what you start to see is there are some interesting hotspots. So, for example, if you look at this, this is actually Cremorne 2090. So there's a lot of people there who are in some difficulty. Lane Cove is also one. And Gabby up there at 2146 is also not looking too good. If you go up a bit higher, you can see places like Castle Hill and the ponds, Stanhope Gardens. That's all where that high growth corridor is. And if you go out this way, you can see that places like Riverston, above Blacktown Vineyard, all areas where you've got huge pressure. Now, if you then go up to the northern beaches, now whilst the overall proportions are still quite low, you can see there at Avalon in that area, there's a bit of a hotspot there, or if you look at Hornsby. And then if you go further up and look towards the central coast, you start seeing quite high proportions there too. So you can really get a sense of where the problem areas are. And so it's quite a useful thing. And what I tend to do personally is to look at both percentages and counts. But it does make the point quite well, I think, that things are actually quite distressed at the moment. Now, if I then go to, let's go to Brisbane, shall we? Do 4,000. Okay, so I'm now looking around, centered on 4,000, and you can see there, as I pull out, you start to see some interesting reddening of some of the areas. So over here, beyond Eagle Farm, you can see that there's actually some issues. Camp Hill, St Lucia. As we pull further out and begin to see a little bit more of the wider areas, you can see that there are some interesting red areas. Some of this is some of the new development that's gone on quite recently. And then if you go further south, you've got Rockley and Salisbury and places like that. And as you pull out, you can sort of see more and more of the problem areas. And as you come a little bit south of Brisbane and head down towards the Gold Coast, you can start to see some quite concerning signatures there. And of course, if you go west, then you go into places like Toowoomba and Lockyer Valley and Ipswich, places like that. And then if you go up to the Sunshine Coast, again, you do see some, not massive, relative to some areas, but quite a high proportion. And quite a few people here bought relatively recently with very large mortgages, and that's really the explanation as to why we've got what we've got. Now, if we can go to Melbourne, we can do something of a similar exercise, and again, looking in percentage terms. So we can start in the centre of Melbourne and pull out. And you can see there that they're already quite close in, up and around Essendon and Moonee, for example, and around Parkville. There are some hotspots. Heidelberg West, Preston, for example, is also showing up as being a bit of an issue. And as you pull out further, you start to see the ring of pain, as it were, around Melbourne. And as you go out west and east, some of the new high growth corridors that you would expect to see perhaps around Casey and places like that, out beyond the inner ring. And then if you look further out there, you start to see Wyndham and places like that over towards the west, areas up here to the north and west. And then if you go up towards Ballarat, you can also see areas like there as well. So it's worth understanding that, these hotspots, they're not just in the centre of Melbourne, but there are some in the centre of Melbourne, but there are also some regional centres too. So it really does make it really stand out. And places like Mitchell, for example, up there as well. Now, if I then go to South Australia briefly. Okay. So again, we're drilling out from the centre of Adelaide, and you can see again the same patchwork. So it's quite powerful when you start looking at these, and you can see that there are areas where there are significant issues. So Campbelltown, for example, here is standing out. Prospect, a few other places too. Hornsey Gale, Gully, for example. And there's a few interesting contrasts. So, you know, one of the things I quite often highlight is Salisbury in the area around there. It's got a very high count, but from a percentage perspective, it's not as high as some others. So it is quite interesting. And again, you get a slightly different view relative to some of the other pictures that I've produced. And, you know, you can pretty much be sure that where the colours are actually redder or orange, there's more likely to be more price falls ahead. Now we'll go across to Perth to 6,000. And again, we'll zoom out from the centre of Perth. And Perth has a very different profile when you start looking in percentage terms. You find closer into Perth, there are actually a few areas where there are some interesting issues. Netherlands, for example, which is perhaps not what you might expect, and Mount Lawley, for example, as well. And even in Mosman Park, it's not, you know, where you might expect to see it. Colleslow's not too bad. Other parts of the Netherlands, but, you know, if you look at this area around here, there's 6069, some issues. And as you pull out, you start to see those same trends, where if you go north and south of the centre of Perth, you then start to see higher representations of more extended stress. And as you go up the coast, so 6034, 6038, 6036, 6030, right there, you can see that. There's Wanneroo there, it's one of the ones in my list. And if you go south, Rockingham and further south, you can also see that there's quite a lot of issues there. Now I'm going to quickly go over to 7,000. This is in around Hobart. And again, we're looking at proportions, percentages. And what's quite significant here is that you do see some percentages. Now, the total count of households is a lot lower, of course, in this particular area. So they don't often stand out when you look at the counts. But when you look at the representation, for example, 7009 is a hotspot. And then you've got some overs here around Clarence City and places like that. So it does tell you quite an interesting story. And I won't do it now, but if you went up to the northern part of Tasmania, you'd also see somewhat similar things. Now, I just want to do one last one, and that's Canberra. Because I think Canberra is looking quite interesting, and there's quite a few concerning signs that I'm seeing. Now, close into the centre, it's not looking too bad. This is obviously around Capitol Hill there. But if you start pulling out, you do then start to see areas where there are some interesting pressures. So 2902, for example, 2900. And even further out, you see some other areas too. So even across the ACT, there are some areas like 2609 where things are pretty good, others where there's some pressure, and others again where there's a lot more pressure. So it shows you the sort of the patchwork that we've got. So I hope that was useful in terms of just giving a bit of a flavour of the way that the story is working. And, you know, I tend to use both the percentage and also the count to be able to actually really drill into what's going on. Okay, so that's that little story. Now let's then just move on and talk a little bit about some of the postcodes. And I want to introduce you to my map of the postcode. This is the data that I use. You've seen this a few times. This is updated now to October. And so this is my summary down to the postcode level. So I have information about individual postcodes. I know the price scenarios, so best, base and worst case, and I'll talk about scenarios in a second. But let me just do that now while I remember. I'm going to come here. Let me just talk about scenarios. So scenarios are a way of sort of exploring the futures. It's not trying to make a prediction, it's just showing you what could be. and it's running forward from today. And we basically have best scenario, which assumes that interest rates are going to stick around the 2.5 to 2.75, and fall next year. Inflation eases ahead of the RBA expectations. Wages rise faster, and there's no recession in Australia. The base case is that rates go to about 3.5%, which will give you mortgage rates of about 6.7% and stay high through 2023, while inflation stays above target until 24, but no recession in Australia. The worst case is that rates go even higher, above 4%. That would put mortgage rates at 7% plus, stay high into 2024, along with inflation. Wages growth stalls due to recession, and later rates fall. So those are the scenarios that I'm using. And back to then the scenario. Now I picked Wollongong just because that happened to be the one I was looking at the time. And you can see there we've got information about the count of households. We've got the number of mortgage stressed, rental stressed, investor stressed, and overall financial stress. Anyone watching the anti-spook videos will have seen this information. Then I've got my best case, worst case, and base case scenarios for houses and units and the graphs that attach to them. I've got the property profile, so I know how many houses, units, and others are there. I know also what the average people ratio, so how many people to properties in the area, which tells you something quite interesting. How many were vacant on census night last year, and the average gross investment yield and the net investment yield. I've got income data from the ATO and also from the household census, and that allows me to calculate the disposable monthly income, and that allows me then to estimate what proportion of monthly income is going to pay the mortgage and what proportion of monthly income on average is going to pay the average rent. So there you go, that's the way that it works. Now earlier on, JJ asked for information about 2450. So let's give it a go. So this is Coffs Harbour. And for Coffs Harbour at the moment, there's 18,700 households in the postcode. There's 35% owning outright, 32% are borrowing, 31% are renting, and 33% of those with a mortgage, or just over 2,000 in mortgage stress, 80% renting and rental stress, and there is some also mortgage stress for investment properties too. So overall the factor is about 40.6%. Scenarios are for houses, the best case is a fall of about 7% cumulative over the next 3 years. In fact, it will be a slightly smaller fall in the third year. The base case is a fall of about 30% over 3 years cumulative, and the worst case is a fall of 50% cumulative over 3 years for houses. Units a little less severely falling. There are 71% of properties that are houses, 13% are units, and 14% are other types of property. And the people ratio is 2.25, so that would suggest some families. 8.3% were vacant on census night, 1,500 properties, and the gross investment yield is on average 3.7%. So that's effectively the ratio of price relative to the average income from rent. Net investment yield is after all the costs, so that's managing the cost, paying the interest rates and other bills, etc., etc. And then that gives us a disposable monthly income of around $4,500 on average. And a typical borrower is putting about 45% of their income, or just over $2,000, on the mortgage, and just over 40%, or $1,800, on the average rent. So that's the story there. Now, the other little trick here is, I wonder if I can get this to work. Just come back here for a second. So Cookie said he'd look up a few examples, and in fact he did look up a couple in 2450. So let me just open up this one. Put this one here. Okay. So this was one that Cookie spotted in terms of a price fall. And this was listed 125 days ago in this postcode. And it's a house on 585 squares, 5 bedrooms, 3 bathrooms, 3 cars. And it was on the 10th of May this year at 2.5 million. On the 24th of September, it dropped to 2.4 million. So there's an example of a property that actually has slid somewhat. The falls are quite divergent, I would say, in some of those areas, but there's certainly enough to know that they're there. Here's another example. This is slightly different. This is actually acreage in the same area, so 2450, listed the 3rd of August, semi-rural acreage at 46 acres, or hectares I should say. On the 2nd of September, 2.6 million, now on the 6th of October, 2.3 million. So again, you can see that there's a bit of a price drop. And what Cookie tends to do is to look for the price falls and to figure out how far they've fallen. That's pretty much it. Here's another one which we might look at as well, again in the same area. And this was the first one's at Korora. House on 695 squares, 3 bedrooms, 3 bathrooms, 2 cars, listed 7 days ago. And on the 18th of August, it was at 1.35 million. On the 30th of September, 1.3 million. And the other one, at Coffs Harbour itself, was a house listed 189 days ago on 26th of April, and 1,144 squares, 6 bedrooms, 4 bathrooms, 3 cars. 26th of April at 1.395. Now on 21st of July, 1.299. So you can see that there is definitely some stuff going on in terms of price falls. So it just shows you a little bit of the sort of the sense of what's going on. And I'm sure if we spend a bit longer, we'd find some more examples, but that just gives you a bit of a flavour. Now, I also, Karma asked me for postcode 4560, so I might just put that postcode in, and we can have a look at that one, just to have a look at another one. So 4560. Okay, so this is Nambour in Queensland on the Sunshine Coast hinterland. And there's 14,600 households, 4,500 own outright, or 31%, 43% are borrowing, more than 6,000, and 25% are renting. Mortgage stress, 50% of those borrowing are with a mortgage are in mortgage stress, 57% of those renting are in rental stress. Overall, financial stress is at 41%. Now, looking at the scenarios, the best case scenario is a rise, cumulatively of 6% over the next 3 years. The base case is a fall of 18%. The worst case is a fall of 36%. And looking at units, best case is a rise of 4.5%, base case a fall of 13%, and the worst case a fall of 26%. And looking at the property profiles, 79% are houses, more than 11,000, a few units. Some are other types of property, that includes things over shops and other commercial premises. The people ratio is 2.34, that indicates some families, I think. And the vacancy rates, 5.4%, 790 on census night. Gross investment yield, 4.6, net investment yield, 1.1. Queensland tends to have slightly better returns relative to New South Wales and Victoria. Average taxable income, 67,000 from the ATO, 73,000 from the census. That's a household view rather than individual view. But look at this, disposable monthly income, 4,500. The average mortgage is just over $2,000, and that's 45.3% of disposable monthly income. Average rent is about 40% of disposable income, 1,869. So you can see that there's immediately, some interesting correlations between what's going on with stress and some of the price falls. And the work I've done on anti-spooks videos recently shows that where the mortgage stress is high, there tended to be more significant falls. And I think we're going to see more of those ahead. Okay, now Nigel's asked for a postcode for 3429, which we can do. Let's put the data in. Okay, let's load that up. I'm going to take that off. 3429. Okay, so this is Sunbury in Melbourne. Okay, so this is 15,000 households, 27% own outright, 51% are borrowing, 20% are renting. Mortgage stress is 51%. Rental stress is 82%, so that's quite high. Overall financial stress, 46%. Scenarios are the best case, cumulative fall of 7.5% over the next 3 years. Base case down 31%. Worst case down 50%. This is for houses, units, not quite so significant falls. but 88% of properties are houses in the area, 7.3% are units, and 4.1% are other types. People ratio is 2.51, and on census night, 4.7% or 696 properties were vacant. Gross investment yield is around 3%. Net investment yield is minus, so underwater, minus 0.1. Average taxable income from the ATO is $76,000 per annum. The household census reported just over 100,000, and the typical disposable monthly income is around 6,478, with about 32% going on the average mortgage at just over $2,000, and the average rent at 27.8%, $1,799. And I will just highlight the fact that these financials are in a better condition than those we saw up in Brisbane, and I think that's one of the reasons why Brisbane is falling faster than some other areas at the moment. Okay, well, that's really flushed out the the request for postcodes. I knew that was going to happen. That's okay. We'll work our way through them. This is another one, 3844, being asked for, 3844. Now this is Traralgon, which is in South Gippsland. 12,000 households, 33% own outright, 42% are borrowing, 24% are renting. I will highlight the fact that where you've got a lot of borrowers, that tells you something quite important about the nature of the the situation there. Some postcodes we've got 50 or even 6% of people borrowing. 76% in mortgage stress, 63% in rental stress, 50% in financial stress. Scenarios are 8% down for houses over the next 3 years, best case scenario, 32% base case, 50% worst case. For units, not quite as low, but still negative territory. 87% of houses, 8% of units, 4.9% of other types of property, and the people ratio is 2.18. And around 8% were vacant on census, not just over 1,000, and the gross investment yield on average is around 3%. The net investment yield is minus 0.4. And I will highlight the fact that a lot of property investors, particularly in Victoria, are well underwater. That's one of the reasons why we've actually got a lot of people now putting their investment properties on the market. Typical ATO, about 80,000 taxable income. Household census around 80,000 as well. And the disposable monthly income is around $5,200 a month, with around 30% or 1,500 going on the average mortgage repayment per month, or 26.2% going on the average rent. And I'll make the point that almost always you see that, in fact, the mortgage holder is paying a high proportion of income relative to the people who are renting. Okay, what else have we got? I have got so many. Let me just go back up a little and see what we've got up the top there. What do you got there? Okay, I'm just going to cover this one here. I can just make sure get that to work. What's gone? Whoops, try again. Okay, this is from Jason. Thank you for the super chat. It's really appreciated, Jason. Can you or anyone in the chat see the problem of removing banks from regional areas at a time when they are converted from COVID, seemingly as justified to close, and then had the floods, as they expect people to just use with interest rates? Sorry, it just dropped off. Yes, this is a big deal. So as you may know, one of the things that I've been doing is campaigning with the regional about regional banks. And APRA, of course, has been misreporting the situation with the number of regional banks that are actually there. A lot of the banks are not offering full cash services now and yet still counted as branches. That's a mistake. Should have been rectified some time ago. But there is a whole swathe of areas now losing branches. So in my local area here, I live north of Wollongong. We used to have a National Australia Bank at Corrimal, one at Fig Tree, and a couple of others in the immediate area. They've all gone. So if you want to get bank with National Australia Bank now, you've actually got to go down into Wollongong, which is a 12 to 15 kilometre trip. There's nothing in between. Now they say, well, you can bank at Ozpost, and you can, but there are very limited services there. So they are sucking the life out of these regional areas. And, you know, some of these areas around here are quite big, but out in the sticks, some of them are even smaller. And it's interesting because I decided that I was going to move my banking relationship to an organisation that was actually in the local community here. And there is still a customer-owned bank. It's you know, a member bank in the local area, not a big one, but it's still supported by APRA, and it's got all of the deposit insurance scheme and everything else. So, and it's still down in town here in my local community, so I can literally walk down the road. And yesterday I walked down and, you know, basically had a conversation with a bank teller, and did all my banking in person in a branch. The point is that there are still people wanting and needing to do that, as I did yesterday. And I do think that the rush to the exit and the closure of regional branches on any excuse, be it COVID or be it, you know, no longer use of cash, is a major mistake. And I'm lobbying the Parliament here as well in terms of trying to get some attention on this very important issue. Now, of course, Robbie Barrett would say, well, maybe Postbank is part of the story. Could well be. Maybe we should have single branch representations of multiple banks. They've tried that in the UK and it's worked quite well. So there are solutions, but no, it's a disgrace what's been going on. And unfortunately, the excuse is, well, nobody uses cash anymore, which is wrong. There's more cash in circulation than ever. And secondly, they're also making the point that it's costly, of course, to keep branch infrastructure in place. But I would argue that it's a social obligation. It's part of the infrastructure of keeping a community alive and well and working. And all the research that I've read around the world says if you take banking facilities away, communities are more likely to fall over and die subsequent. So it's a critical issue. And thanks again for the super chat, Jason. I really appreciate that. Okay, now let's have a little look and see what else we've got in terms of requests. Lots of comments which I'm not going to shut, but Adam's Apple wanted Narrabeen 2101. Let's do that one, shall we? Here we go. Get rid of that. Okay, obviously it's Northern Beaches. I would say that the Central Coast flag there is not quite correct. We've got a few little data errors in our very complicated database, but anyway, we've got it in the right area. It's Sydney Northern Beaches. 7,700 households, 33% own outright, 37% are borrowing, 29% are renting. Borrowers in mortgage stress, 9.1%, that's pretty low. 66% of renters in rental stress, and overall financial stress at 36%. So scenarios are best case, over the next 3 years, a fall of about 4.5%. Base case down 29, worst case down 47 for houses. And units down 3, down 20, down 34 over the next 3 years. 53% of properties are houses, 35% are units, 11% are other types of property, and the people ratio is 2.38%. 6.1% were vacant on census night, 475 properties. The gross investment returns about 3.5%. Net investment yield on average underwater, 0.2%. ATO reported $98,000 in the tax year 2021, and the household census reported 116,000 average household income. Monthly disposable income around $6,700, and the 53.1% or $3,600 for the average mortgage, and 44% or $2,900 for the average rent. That means that people are very leveraged up, and I've certainly seen that in some of the data. So that's one of the reasons why we have what we have there. Okay, let's look at another one. So Peter Hill said, are you able to look at stats for North Richmond 2754? We'll give it a go. 4. Okay, now this is one where the postcode count's quite low, so just be a little bit cautious of this, because what you actually have here is rounding issues when you get very small counts. But anyway, 2,700 households in the postcode, 31% are owning outright, 41% are borrowing, and 27% are renting. There's no real mortgage stress there at the moment, but there is some rental stress, about 37%. And the scenarios are: best case, house rising 3.9% over the next 3 years, the base case down 20%, the worst case down 39%. For units, the best case up 2.9%, the base case down 15.3%, the worst case down 28.7%. And looking at the property profiles, the typical mix of houses is 81% houses, 1.3% units, so mostly houses, and 16.9% other types of property, including over shops. People ratio is 2.47. The vacancy rate's 4.6% or 124, so pretty low. And the gross investment yield is 3.1. The net investment yield minus 0.6. ATO said $77,000 per annum, typical income. Household census said $91,000. And that translates to a disposal monthly of around $6,000, with 47% or $2,800 going on the typical mortgage, and 33.8% or just over $2,000 going on the typical rent. And I will just make the point here, of course, with the interest rates rises that have flown through, typical mortgages have gone up by somewhere around $1,000 a month on average. It varies, of course, in different locations. Bigger mortgages even more so. If it's fixed, it won't go up yet, but it will go up later. So that's one of the reasons why some of these ratios are a lot higher than they used to be, because people are having to pay a lot more because rates have gone up. Okay, let's have a look. Simon asked, first time I've watched, is it possible to access this map online? The short answer is no. The reason is that I use a very specific mapping tool called Caliper, and they have the ability to put this up online, but it's hugely expensive. So far there hasn't been enough interest for me to actually make the investment to make the maps available online. But I guess that the question is, if there's a huge level of interest to get online access to these maps that I showed you earlier on, then put the comments below, and if there's enough demand, then I'll look at it again. I looked at it about 2 years ago, and the costs are huge, simply because I have to pay a large license fee every time people access the maps. But if there's enough interest, then I'll look to see whether there's a way of doing it, because I think they're very, very powerful. What I can say to you is, if you want a map for a particular sort of suburb or suburb area, I can try and help you with that, but it won't be a dynamic map. It'll just be a picture of that area. What you need to do there is send me a message via the DFA blog, and if you ask for a particular map, or if you want a snapshot of a particular postcode, I'll try and help. I will say, though, I've got a big pipeline of requests, so it may not happen immediately, but if you ask, I will get to it in due course. Okay, what else have we got? Thank you, Drew. We try to keep the bastards honest. Yes, indeed. It's been a lot of my time trying to keep the politicians and the regulators and everything else. You've been following, assume you've been following the story with ASIC, right? We got 2 inquiries into ASIC. It's pretty funny, really. We hope to interview the guy who kicked off one of the inquiries in the next few days on the IOTP, so we'll see whether that comes through. Okay, what else have we got? Just running down the list now. 4510. Did I do that one before? I'm not sure. I don't keep a list, you see. Let's have a look. Do I recognise it? No, I don't think so. Okay. So 4510 is Caboolture in Brisbane and Moreton. 20,000 households there. 24% own outright, 37% are borrowing, 38% are renting. And 16% are in mortgage stress of those borrowing, just over 1,200. 83% of those renting are in rental stress, and overall financial stress is 43. The scenarios are: best case scenario, 6% higher over the next 3 years. The base case, a fall of 18%. The worst case, a fall of 37%. For houses, units, slightly smaller fall. And looking at the property profile, 83% houses, very small number of units, and a few other types of properties there. The people ratio is 2.43%, and the vacancy rate 6.9%, or 1,461. These vacancy rates are very interesting because it suggests that there is a lot of vacant property in some areas. Gross investment yield is around 4.6%, the net investment yield is about 1%. Taxable income on average $62,000 per individual, or $68,000 per household. And that translates to a disposable monthly income around $4,400, with a typical mortgage at around $1,900 at 43% of disposable income, and a typical rent at 36.6% of disposable income in that particular postcode. Okay, done that one. Let's do that one now. 6210. Ask Sharon. See what I can do that one for you, Sharon. 6210. Okay, Meadow Springs, Mandra. One of my favourite postcodes. Okay, so in this particular postcode, which includes Mandra, Meadow Springs, and a few others as well, but obviously Mandra is, I've used that a few times. 31,000 households there, 33% own outright, 38% of borrowing, 28% of renting. The borrowers in mortgage stress, 27%, or more than 3,000. 58% of renting households are in rental stress, and overall investment stress is quite high too, so we get a metric of 32%. So the scenarios are: best case scenario for houses around 4%, base case down 20%, worst case down 38%, units 3%, down 14%, down 28%. And most of them are houses, 99.9%. People ratio is 2.6, but look at this, vacancy rates, 17.1% were vacant on census night. That doesn't look right to me. There's something weird about those numbers, so ignore those. That's not, I think there's a number missing, because it should be a lot higher than that. Make a mental note to go and check it out. Anyway, what we can say is the taxable income, investment yield is 4.2 and 0.8 net investment yield. Average taxable income, 87,000 for the typical household, or 60,000 for the typical household from the census. Disposable monthly income just over $4,000 on average, with 50% going on a typical mortgage, just over $2,000, and 37%, $1,495, going on the average rent per month. So there you go. Jonathan asked about 4128. Okay, let's get rid of that so you can see it. 4128, so this is in Brisbane and Moreton, and we've got 6,000 households in the area, 22% own outright, 56% of borrowing, so that's very high. A lot of people with mortgages, 21% are renting. A lot of people are in mortgage stress, a lot of people are in rental stress as well, and the overall financial stress number, very high. So best case scenario, a fall, small fall, 2.8%. Base case is looking at 27% down, worst case 45% down. Units, not quite so bad. 88% of properties are houses, 5.1% of units, and a few other types of property. And the vacancy rate's 3.8%, or 229. And 4.6% gross investment yield, 0.8% net investment yield. Average taxable income about $74,000. Census said $110,000. Monthly disposable income around $6,300. Typical mortgage, $2,300 a month for 36% of the disposable income. Average rent, 31.2% at $1,993 per month. Okay. Another one here, 3250. So this is Colac. And here, 5,300 households, 38% own outright, 34% borrowing, 26% are renting. Just 10.5% in mortgage stress, that's pretty good. Rental stress is much higher at 66%. And the overall financial stress metrics, not too high. Looking at the houses, well, scenario is just a small fall over the next 3 years, best case. 25% down, base case. 44% down, worst case. Units down 1.2, 18.6 and 33.2% over 3 years. 88% of properties are houses. Units don't seem to be much around. Other types of property are. 2.1% the vacancy. 2.1% the people ratio. The vacancy is 8.3% of 463. And the gross investment yield is 3.4%. Net investment yield is flat, 0. Average taxable income, $64,000. The average household census was $65,000 per annum. Translates to just over $4,000 per month. And that's 37.7% going on the mortgage at $1,500. And for the average renter, 31.3% or $1,296. Okay. George, you got there. I gave you that one, I'm pleased to say. Maria, hello, nice to see you. Thanks for dropping in. I'm a bit behind in the chat, as you can see there. Drew asked for 3065. Now 3065 is Fitzroy. 4,800 households in the postcode, 17.6% own outright, 22% are borrowing, but 59% are renting. 30% are in mortgage stress, 50% are in rental stress, overall financial stress 47%. Scenarios, best case down 4.3% over 3 years, base case down 28%, worst case down 47%, and the units 3, 21, 35% all down, 3.2% are houses, 59% are units, and 37% are other types. That would include other shops and other premises. Much lower people ratio, 1.64, so it tends to be a different type of population, more individuals, perhaps younger as well. Look at this, 18.8% vacant on census night, more than 1,000. So that will probably be property that would have been previously let out to students, but of course students weren't there at that time. Gross investment yield 3.9, net investment yield 0.9. Average taxable income 106,000, or from the census 114,000. Disposable income around 8,000 a month. Typical mortgage around 3,000 with 37.5% of the disposable income. Typical rent $2,200 a month at 28.1%. Jason, thank you for the super chat. 3188, I can do that. Thank you very much. Hampton indeed. It worked. That's good, isn't it? Okay, so this is Hampton in Victoria. It's in the area of Bayside and Melbourne inner south. 7,400 households, 35% owning outright, 38% of borrowing, 26.7% of renting, and 15.6% in mortgage stress of those with a mortgage, 47.4% of those renting, 41% stressed investors, so a lot of investors having difficulty too. Overall investment, interesting question, and the financial stress metrics 40%. So scenarios down 5.9% best case down 30, worst case down 48%. For units down 4, 21 and 35%. And 6% of the places are houses, 16% are units, and 23% are other types of property. People ratio is 2.26. And the vacancy rate last year was 9.8% at 763, which is quite high. Gross investment yield 3.4%. Net investment yield is minus 0.4%. That explains some of the financial stress amongst investors, I suspect. The taxable income is quite high, 131,000 from the ATO, or 125,000 from the census. Disposable monthly income around $6,900. Typical mortgage, $3,600, which could be around 52% of disposable income. Average rent, $2,347, 33.9%. Okay, here's another one. Jason, another super chat. Thank you very much. I really appreciate it. It helps to cover the costs. You wanted a couple more there. 3065. Fitzroy. Did I do Fitzroy before? I can't remember. Anyway, I'll do it again in case I didn't. I should write down the ones I've done, but that would just be another thing to think about. So if I've done it already, I apologise, but I'll do it again, just quickly. So Fitzroy, 4,800 households, 17.6%. I have done this one. 22.5%, renting 59.9%. And the scenarios are 4, 28, 47 down for houses and 3, 21, 35 for units. Most of them are units in the area or other types of property. Vacancy rates extremely high, 18.8%, just over 1,000. Gross investment yields 3.9, net investment 0.9. Taxable income 106,000 from the ATO, 114,000 from the census, and disposable income around $8,000, with 37.5% or 3,000 going on the average mortgage, 28.1% going on the average investment property. And then you asked about another one, didn't you? 2122 Ravesby. Did I read that right? 2122. Now you said Ravesby. I've got that as Marshfield and Eastwood. So I'm not sure whether that's the same place or not. I don't know enough about the geography, but I'll do it while I'm here anyway. It's 11,900 households, 28% owning outright, 31% borrowing, 39% are renting, 40% in mortgage stress, 75% in rental stress, 41% are stressed investors, and financial stress is at 58%. So scenarios for a house down 11, best case 35, base case 54% over 3 years, worst case. Units down 8, 26 and 39%. 43% of the area properties here are houses, 25.5% are units, and 30.6% are other types of property. 2.46% is the people ratio, 7.4% vacant, just 903. 3.4% gross investment yield, 0.5% negative is the net investment yield, and the typical income 87,000 or 101,000 from the census. Monthly disposable income $5,900. Typical mortgage around $3,000 or 50%, and typical rent about 38%, $2,200. There we go. So let's see what else we've got. I'm running out of time too, aren't I? 5095. Okay, so this is Pucara in the area of Salisbury and Adelaide. Do you remember that was one of those areas where the stress was probably a bit higher? 8,400 households, 20% own outright, 43% of borrowing, 36% of renting. 46% of those with a mortgage are in mortgage stress, 37% are renting and rental stress, and the overall financial stress metric is 41%. Price scenario: house up 6.6%, base down 17.8%, worst down 36% over 3 years. Units 4.8 high, down 13, down 26. 73% of houses in the area, 10% of units, 16% of other types of property. The people ratio is 2.45. Vacancy rate was 5.8%, 491. Gross investment yield is 4.4%. Net investment yield is 0.9%. Average taxable income around $70,000 from the ATO, or $86,000 from the census, and the disposable monthly income around $5,400, with 33.2%, or $1,800 going on the average mortgage, and 31.8% going on the average rent, $1,745. Okay. Now, Mr. Blister asked this question. Look at that. Whoops. Put that back on. A quick question. If property prices are up from the beginning of the year and inflation is higher due to that period, does that mean that property is a loss? Yeah, I have not corrected any of this for the effects of inflation. Now, I could do that, but then it gets even more complicated. So if the fact is that the value of your dollar is being depreciated, as it is, let's say at 8%, then you could, in theory, add an extra 8% down for all of the property values here. That's quite true. I haven't done that, but you could. So that would be an inflation-adjusted view of the world. Now, if inflation stays high, we may have to start doing that, but I haven't done it up till now. Okay. Big N said, Penrith 2750. Now, what I'm going to do in a minute is I'm going to finish this one. And then what I'm going to do is I'm just going to go through the rest of the points I wanted to make briefly in the show, and then I'll do a few more afterwards for those who want to hang around. So if you've still got a request in, hold on. You might still get it answered tonight. This is Penrith, 20,000 households. 24% own outright, 34% are borrowing, 41% are renting. Mortgage stress, 43% more than 3,000. Rental stress, 38%. And the financial stress numbers, not too bad. Scenarios. Best case, down 2% over 3 years. Base case, down 26% over 3 years. Worst case, down 44% over 3 years. Units, a little less significant. 65% of properties are houses, 21% are units, a few other types there too. People ratio is 2.23, and the vacancy rate was 7.1 or 1,457 properties there. Gross investment yield 3.2, net investment yield 0.2 minus, so losing money in cash flow terms. 76,200 for the average ATO for disposable income, taxable income. Household said $86,000. Monthly disposable income on average, $5,589. And that means that around 44% are going on the mortgage at $2,400 a month, and the average rent is around 34.8% or $1,900 per month. Okay. So that's that one. Jason said, I may have got it wrong, was asking 2122 for someone else, but may have miskeyed in the process. My apologies. No problems. If you think of what the right postcode is, just send me a message. I'll send it to you after the show. All right, so I'm just going to now come back to the closing out the show. And I just want to make a couple of points. In the current environment, one of the things I'm concerned about is people getting themselves into difficulty. And I always mention the 1-800-007-007, which is the National Debt Helpline. This is a free service. It's run by the government. And you've got financial counsellors there who can actually help and guide people if they're in difficulty. The reason I want to put this on the table again is because in my experience, a lot of people who are getting into financial difficulty at the moment don't know who to turn to. And there is a risk. If you, for example, turn to a mortgage broker, they might say, well, just refinance and pull your equity out, but that may not be the good answer. Or you might actually go onto a website and find yourself being invited to sign up with somebody who you pay a fee to deal with your debt. Don't do that. They're actually out to make money from you rather than actually deal with it. But these guys, there's no charge. It's a free service, and it's a really good service. So 1-800-007-007 if you need help, and they can really guide you through the process of trying to work out what to do. If you are in financial difficulty, talk to your financial advisor if you've got one, or talk to the bank if you've got a mortgage. The banks are required to assist, and they do have a hardship scheme. But it is sometimes important to get your ducks in a row first. So these financial counsellors are very important. And I would say a lot of financial counsellors are extremely busy at the moment. A lot of people in difficulty because this is a new environment. We've never seen rates go high so quick. A lot of people are highly leveraged, big mortgages. The banks overlent massively to a lot of people. And of course, they're now trying to deal with it. That's one of the reasons why the RBA kept rates, creeping up, not going up really high, because they knew a lot of people would get into difficulty. But this is a really important number to take down. So if you've got financial issues or you think you might, 1-800-007-007. I don't get anything for referring anybody. It's just, I think it's a really important number to keep in the back of your mind. Okay, so that's that. Then in terms of just a few other quick comments before I close out the show, I do actually have this, which is my scenarios. This is the average for the total situation across Australia. This is houses. So basically the best case for average across Australia is a small rise over the next 3 years. The base case is a fall down about 22%. This is for houses. The worst case for houses is a fall of 40%. So somewhere between there and there over the next 3 years. And I've got the same for units as well. So units, pretty close trajectory, but the falls for units over the next 2 and 3 years, not so high. The reason it's not such a deep fall is because they never rose as much over the last 2 or 3 years. Houses went through the roof, units didn't. So that's why. But even so, worst case scenario for units down 30%, base case down about 16%. Okay, then just before I want to finish off, if you would like to get a particular postcode data set, you can contact me on the blog. And if you go to the DFA blog, down at the bottom of the blog, there's a contact me little dialogue. If you send a dialogue there, I'll get it. digitalfinanceanalytics.com/blog is the link. Or if you go to digitalfinanceanalytics.com, you can go directly through to the blog from there too. So that's how you can get hold of information if you want to ask me a question, or if you want to inquire about the one-to-one service. The DFA blog is the way to do it. As I say, little dialogue down at the bottom there on the bottom right. Click on that. It will actually then take you through to the dialogue form. I do say again, I've got a backlog. I'd also make the point that if you want to get the data set, so I've been using my data set this evening, it is available for $50 per month, US dollars that is, per month. You can sign up, and if you sign up to Patreon, you can get hold of essentially the data set that I've been using tonight, and also access to the online tools that allows you to look at it remotely if you don't want to look at the Excel spreadsheets. I've also got a sort of a front sheet as well. So that's what I do there. $50 US a month is the source of the data. And if you want to make comparisons between different areas, different postcodes, or even track over time, that's quite a useful tool. So that's worth mentioning, I think. If you want to make a contribution, by the way, you can also make a contribution via PayPal. And there's a very simple PayPal me /Martin DFA if you'd like to make a contribution to what we do. A lot of effort involved in doing all of this, so any support that you feel able to give would be greatly appreciated. And don't do it to make more profit. I do it because I think this is a really important conversation to have, and a lot of people struggling with what's going on at the moment. I want to try and help as best I can, and I think sharing this information is a very powerful way of helping. And then finally, just to say that next week, Robbie Barber will be on, and we're going to have a discussion centered around the financial system on the edge. So join us next week with Robbie there for that. Okay, so I'm happy to do just a few more. 2212. You missed Jason's 2212. Did I miss 2212? Or was that the one I tried to do? It didn't work. 2212. Ah, there we go. 2212. Here we go. So this is Jason's 2212. 5,900 households, 28% own outright, 37% of borrowing, 34% of renting, and 11% are in mortgage stress, 70% in rental stress. Overall financial stress not too bad. Scenarios: best case down 3.9% over 3 years for houses, base case down 27%, worst case down 46%, and for units down 2.7%, 20% and 34%. 64% of properties are houses, 6.4% are units, and 29.6% other types of property. 5.5% are vacant, 328 on census night. Gross investment yield around 3.5%, net investment yield flat. Average taxable income $75,000. The census said $100,000, and that translates to a disposable monthly income on average about $6,000. Typical mortgage around $3,000 or 47.7%, and the typical rent 26.4% or $2,292. Okay. Otto said, do I accept live chickens as payment? Tend to prefer the the real McCoy rather than chickens. Don't tell Edwin, because I know Edwin's very much into chickens. Very good. Okay, here's one from... Can you please check 5047? Sure can. I could do this all evening, couldn't I? Yeah. Except I'll run out of smoke eventually. Okay, 5047. This is Sturt in South Australia. 3,800 properties, households, I should say. 26% own outright. 37% are borrowing. 36% of renting, 12.5% in rent, mortgage stress, no rental stress, and best case scenario up 17.6% over the next 3 years. Base case down 6.9%, worst case down 25% for houses, and as there are almost no units, I won't give you units, but 69% properties are houses, and 29% are other types, including over shops, places like that. People ratios 2.23% and 5.8%, or 225 properties are vacant on census night, and the gross investment yield is around 4.7%. Net investment yield 1.7%, which is one of the best we've seen so far today. Average taxable income around $66,000. Household census said $74,000, and the monthly disposable income around $4,600. Typical mortgage just over $2,000, somewhere around 45% of disposable income, and typical rent $1,700 at 37% of disposable income. Okay. Okay, another one here. 2093. 2093 indeed. Let's do that one, shall we? All right, so this is Balgalaf, or something like that. I'm not very good at pronouncing some of these names. I do apologise for that. I want to make them Welsh, and it's probably not Welsh. $8,800 households, 31% own outright, 40% are borrowing, 27% are renting. Mortgage stress 17%. Rental stress 79%, stressed investors 49%, and the financial stress at 49%. So scenarios: down 10% best case, down 34% base case, down 54% worst case over the next 3 years. Units down 7, 25 and 38%. Looking at the household compositions, 4,400 or 53% of houses, 34% of units, 12.1% are other types, and the people ratio is 2.54. Vacancies were 5.6 or 500 on census night, and the gross investment yield is about 3.6. Then investment yields 0. Average taxable income we're at 144,000. Average household from a census perspective is 153,000. Disposable monthly income around $8,000. Typical mortgage around $4,000 or 51%, and typical rent around $2,900 or 37%. This is a great example of where a more affluent suburb is still feeling some difficulty at the moment. Okay. $3,048. Meadow Heights in Melbourne. 5,600 households, 26% own outright, 41% are borrowing, 32% are renting, 91% are in mortgage stress, 95% are in rental stress, overall financial stress 74%. That's one of the highest we've seen, isn't it? So, scenarios: down 16, best case; down 40%, worst case; base case, 59% worst case; and units, I won't bother with those, very few units around. 84.1% of properties are houses, 2.99% the people ratio. There were 6.4%, or 360 properties were vacant, and 3.4% or 0.4 minus net investment yield. Average taxable income, $56,000 and $63,000 respectively, and disposable monthly income around $4,000, with around 43% go on the average mortgage at $1,132 and 42.2% on the average rent at $1,700. So again, a very interesting scenario there. Very high levels of mortgage stress in that particular area. All right. I think that's about it. One more. Whoops. Let's go one more. Should we there? What is that one? Missed. Hang on. Try that. Coal Point 2283. I don't know what that is. 2283. Should be okay. Central Coast. Yeah. 9,900 households. 38% own outright, 37% of borrowing, 24% of renting, 47.7% in mortgage stress, 68.8% in rental stress, overall 39%, and that's down 7.31.50 over 3 years for houses, or down 5.23.37 for units over 3 years. 87% of houses. And 2.26 is the people ratio, 6.7% is the vacancy rate at 673, 30.5% gross investment yield, 0.1% net investment yield. Typical income, $78,000 from the ATO or $74,000 from the census. Monthly disposable income around $4,700. 43.9% going on the average mortgage, just over $2,000, and 36% going on the average rent at $1,719. Okay, we'll do one last one. Sasha. Manly, 4179 in Queensland. Okay, this is the last one, folks. So hang on to your hats. 30% of 7,900 properties are owned outright. 44% are borrowing and 25% are renting. Mortgage stress, 28%. Rental stress, 63%, and overall financial stress, 35%. Scenarios: up 7.8% best case over 3 years for a house, down 16 or down 34% for the other two scenarios. Units, very small number, but up 5, down 12 or down 25, and 79% are houses in the area. 2.45% the people ratio, and 5% were vacant at 394. 4.6% was the gross investment yield. Net investment yield is 1.7%, and taxable income, $90,000 from the ATO, $108,000 from the census. Translates to a disposable monthly income around $6,579, with 38.7% going on the mortgage at $2,500 and 31.8% going on the typical rent. And there we are. Right, so two things I want to do before I close. First is just to tell you what happened with the poll. So I'm going to end the poll. And that means I now can't see the poll. That's very silly, isn't it? I should have read it before I ended it. Hang on. Let me try and find the poll. There you go. Okay. So the question was, the RBA did 25 basis points today. Which is most true? They should have done more, 58%. They lifted as expected, 29%. Whatever it takes to save property, 11%, and they should be cutting rates 1%. So they should have done more was the consensus. So there you go. And then the other thing we should always do, of course, is just have a last look at the doggies before we close out. They're sound asleep. They did wobble around a bit through the session, but they really got a bit bored when we went on the postcode. So sorry that we didn't get much life out of them, but nevertheless. So there you go. Well, I want to say thank you very much for hanging through to 9:49 p.m. It's a long show, isn't it? But I hope you found that useful. I guess I want to make three quick points. If you have financial pressures, don't just ignore them and they won't suddenly cure themselves. You've got to take initiatives, talk to those who know how to deal with it. Secondly, if you have a mortgage, the banks are under an obligation to try and assist. And third, things are going to get probably worse before they get better. So plan now for what may be required ahead. So those are, I think, things just to leave you with. I want to say thank you very much for spending some of your Tuesday evening with us. If you didn't get your specific question answered, particularly if you want a particular postcode, again, contact me via the blog, and over the next week or so I'll try and throw you the data. Or if you'd like to sign up via Patreon, you can get the whole data set and then you can play to your heart's content, which of course we have a lot of people who do that. So it's one of the reasons why we keep plugging the data out. So I want to say thank you very much for your spending time with us. Take care, keep well, and we'll look forward to seeing you next week and follow our recorded shows. Meantime, there's always more stuff coming. So continue to check us out, and thank you very much for liking the show. If you've not done so, please do so, and please also share the post if you'd like to spread the word about what we do here. That would be greatly appreciated. So this is Martin North from Digital Finance Analytics signing off. We'll see you next time. Cheerio.